Well, yesterday, Fed Chairman Jerome Powell gave his speech at Jackson Hole, which people have been anticipating. Jackson Hole, for those of you who don't know, is this lodge that the Fed has some big retreat at every year, where normally all the different branches of the Fed will come together and meet and give speeches and pat each other on the back and talk about how great they are. This year, of course, because of virus concerns, a lot of it was done remotely and it was sort of diffused, so it wasn't really a retreat in the traditional sense. Powell gave his speech remotely, and the doves, let's say, were quite disappointed in Powell. There was great hope that Powell's speech in Jackson Hole would be significant in that it would expand the Fed's purview and the Fed's outlook with regards to the aggressiveness of their monetary policy. In other words, they wanted Powell to come out and commit to printing even more money than he is right now, and that he has been printing in recent years. This could have manifested itself in a number of different ways, whether that's raising the inflation target to 2.5% per year instead of 2% a year, which is where it's been, I believe, since 2012, and 2% has always kind of been sort of the default monetarist number. Don't ask me why it's 2%. That was just a number that Milton Friedman sort of pulled out of a hat and said, okay, well, let's always target 2% inflation, and so that's kind of what central bankers seem to think is, the gold standard, no pun intended, because of course it's very different from the actual gold standard, which would apply in this situation since we're talking about monetary policy. Perhaps that was a poor choice of phrase on my part. And so Powell, given all this, if he raised the target to something higher than 2%, let's say 2.5%, what that would do is that would give him more latitude to print more money. But frankly, it doesn't seem right now that the inflation target, the CPI target, or is it, no, I don't believe they use CPI, they use core PCE, is the number that the Fed looks at, which is even lower than CPI by a few basis points. That number really isn't restricting them, because the way that they have this worded, I guess the only adjustment that they really made was they said that, it has to average 2%, so it's okay if it goes over 2% sometimes. It's not like 2% is the ceiling, 2% is the average. So for as long as we are, below 2%, which we are quite a bit for many years, well then, if we're above 2% for a little while, that's okay, as long as we average 2% in the medium term. Well, they expanded that slightly. They changed the language so that it's the long term. So what that means is that inflation can get above 2% for a little while, and we're okay with that. But again, this doesn't really, people who are worried about the Fed's consumer price inflation targets are not really paying attention to what the effect of the Fed's monetary policy is. Fed monetary policy has not had an impact on consumer price inflation. That money does not get to consumers. Ordinary Americans do not see the money that the Fed is creating, except for, with the exception of when they go to buy a home, because then they're getting a loan from a bank. They are directly, engaging with the money that's created by the Fed then, because the Fed's loose monetary policy and low interest rates enables people to buy much bigger homes than they otherwise would be able to afford. Housing prices, as I've said before, would be a fraction of what they are in America right now if it weren't for these absurdly low interest rates, because interest rates would be higher, and so people would not be able to afford to spend as much on a home. The principal could not be as big. Other than that, though, all of this money that the Fed creates just goes into the pockets of bankers and people who own risk assets like bonds and stocks and all that stuff, as I've said time and time again. So they are really not being constrained in how much money they can print by, consumer price inflation. So I don't really see why the Fed would feel necessary to raise their targets, even though that's what markets were hoping for. For some reason, the stock market thinks that the Fed would be able to increase stock prices even more if CPI or core PCE was at 2.5% a year. And, who knows? Maybe all of that speculation that was going on in the media about what markets were expecting ended up being wrong, because markets didn't tank yesterday because the Fed still closed green. And maybe that's because, like I was saying, it doesn't matter what consumer price inflation is. That doesn't stop the Fed from inflating the stock market, which they did yesterday, just like they have every day. Again, we're in the middle of a depression. Stocks should not be at all-time highs. If anything, they should be at the lowest point they've been in the last decade, over a decade. They should probably be somewhere around where they were in relative terms to where they were like in 2009. And the reason why I say relatively is I say market cap to GDP. That's the number that you should be seeing. The size of the stock market relative to the overall economy. The stock market needs to come back down to earth, and it needs to reflect the actual domestic economy. But that's not going to happen. The Fed did not change anything. What the Fed has been doing is essentially what the Fed is going to do until this whole situation is over, until the end of their reign as the Central Planning Board of the United States. The Fed is going to continue this very same policy that they are engaging in now. Now, interestingly enough, after this news yesterday, after the Fed decided that they're not going to raise their inflation target, the dollar actually went down. The dollar sold off. And I'm not exactly, it doesn't exactly make sense to me because, the Fed is essentially saying we're not going to inflate the dollar as much. And so people are now think that the dollar is going to be worth even less. I don't quite get where that's coming from, other than people were saying, well, if the Fed isn't going to be the one to stimulate the economy through more money printing, well, then the federal government's going to have to do it through fiscal stimulus, and that's going to create inflation. And it's like, well, yes, but the federal government's going to get that money from the Fed. So it's still the Fed creating the inflation at that point, if we do end up getting it. But of course, the USDX or the DXY, whichever index you're looking at. Actually, USDX is not. That's not the abbreviation for that. I forget what the Bloomberg Dollar Index ticker symbol is. Whatever. You know what I'm talking about. The value of the dollar in the foreign exchange markets. That does very much affect inflation in the United States because we import so much of what we consume here. America has such a massive trade deficit that the value of the dollar in the foreign exchange market is very important to consumers. That matters much more than anything that the Fed does, since what the Fed does, affects bankers essentially. And so if the rest of the world, if people who own dollars in the foreign exchange market start selling it off and decide they don't want dollars, well, that's going to hit Americans much harder because that is going to drive up the price of imports, which is, most of what we consume. Now today, a former president of the Atlanta Fed was on CNBC, and he is essentially, he of course is not saying that this is the likely case. But he's saying it's quite possible that we have a double-dip recession. And, what a double-dip recession means is that essentially the conventional way of thinking right now is that we've already bottomed in our economic downturn, even though there's still a million people every week filing for unemployment, which I forgot to mention yesterday. Unemployment numbers came out for the week. Yeah, 1 million people, again, filed for unemployment. That number is still that's still incredibly high. That's a lot of people feeling real pain every week. Yet if you turn on the financial news, people think that everything bottomed out in March when stocks bottomed, and now everyone is back on the road to recovery. So they think of it right now as we're on the V-shaped recovery path right now. But this guy is saying that there might be another dip. Because they still don't think that we're in the middle of the dip. And so if he's right, that means that there's going to be more fireworks ahead, and that that might actually come and impact asset prices, which of course is entirely necessary if prices are ever to make any sense ever again in this country. We have tens of millions of people recently unemployed who are not able to find another job. It does not make sense that financial assets would remain so highly valued, because, I mean, if you think about stocks are a claim on the economic output of American companies. And if these companies are not outputting as much, well, then what is their stock worth? I mean, we're not losing tens of millions of people, to unemployment because of, automation. It's not that these companies are becoming more efficient; they don't need as many workers. They're laying people off because they are producing less. These companies are less active, and of course, with all these companies, laying people off, there's going to be less demand for their products. I mean, we see this with the airlines. Nobody's flying around, and the airlines are laying off tens of thousands of people. MGM Resorts laying off like 19,000 people today. And the way that unemployment works in this sort of a situation is that if you just shut down the country, and tens of millions of people lose their jobs, the labor market is not something that is so flexible. You don't just bend the labor market and push it down for a couple months, and then you take off the pressure and it bounces back. You don't get a V-shaped recovery in that sense. And there are, of course, many reasons for that have to do with the government, things like that. Sure, the labor market is very much hampered in the United States, and so it's not as dynamic as it optimally would be. But the fact of the matter is that with what's going on right now, you have a lot of small businesses who employ most people. Most people do not work for Walmart, contrary to how it might seem. Most people do not work for chain stores. Most people work for small mom and pop businesses in this country, and those are the businesses who cannot survive right now. Those are the ones who are going to close and never reopen. And so therefore all the people who work for them have to find new employment. Those jobs can't just be, they don't just come back, they have to be created once again. Those jobs are being destroyed permanently. But I guess people aren't thinking about that as much because these are not the companies that are publicly traded, on major U.S. indexes. There's an interesting article about Powell's speech yesterday by Rabobank, which was posted at Zero Hedge, and I think I'll link to it below in the description. And I thought that the framing was very prescient. They essentially are thinking that the Fed increasingly looks like the central planners of the late Soviet Union, and that's exactly what they are. The Fed is the United States' central planning committee. They are the same as the Central Committee of the Soviet Union. And they are reacting to the decay of America, the decay that their predecessors have wrought, and they are doing nothing, just like the Soviets did. You have all these eggheads in there thinking about how, we can tinker this or tinker with that and adjust this and, turn this knob and pull this lever. And it doesn't change anything if the whole machine, its entire design is fundamentally flawed. You can try and grease every squeaky wheel you want, but if it's a bad design, the machine's going to stop working eventually. And that's what happened to the Soviet Union, and that's what's happening to America. These riots are very much a part of it, and the problems that we see here cannot be solved by merely tinkering with the rate of inflation in consumer prices, or by inflating another stock market bubble. And perhaps that's why the Fed is doing nothing. Perhaps the Fed is just apathetic at this point. Perhaps they realize that there is little that they can do to change anything, and so they are electing to do nothing. Powell is just going to maintain the course that's been set and charted, and not deviate from, lest he take any radical actions to try and save this ship from hitting the iceberg that we've been barreling towards for decades, because he might be blamed if he fails to save it. Ultimately, the safest solution is just to keep your head down and hope that nobody realizes you're there. Meanwhile, the country just falls off a cliff. So, with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So, I'll see you folks back here tomorrow.